The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Welcome to How to Money with Cole and Bailey. I'm Cole.
And I'm Bailey.
We're financial advisors at Full Swing Financial, where we coach people every day on their money.
Each episode, we cut through the noise and focus on the financial decisions that actually matter.
Our goal is simple, to help you feel more confident and more in control of your money.
Let's get into today's episode. All right, we're back, and it's that time of year, Cole J. Everyone's talking about it.
It's
taxes.
Tax season. We're getting all the questions, the people that, trying to find tax documents or make those last minute decisions that are going to move the needle for them.
I will say this episode is for everyone. Everyone will find something that could benefit them this past tax year, this upcoming tax year. I know not everyone likes talking about taxes, but it's important. It's important to understand them because they impact everyone.
And we've had a lot of changes the last,
Yes.
Couple years with different legislation that's gone through. From 2024 is significantly different than 2025. And then 2026, we have some increases, different things. We're going to go through contribution amounts, different tax deductions. We're going to give you a little
all the things.
Education on some tax terminology too that everyone should know.
Yeah. So
I think everyone should know.
Yeah. People are like, we don't care. Yeah. You do care. You do care. But some of you have already submitted it. That's okay. Some of you have not. But if you have not submitted your taxes, just pause because you can still max out your IRAs. So you have till April 15th to still max out those IRA contributions. And I don't think everyone knows that you have until April of this year to contribute for 2025.
Yep. We're in that odd time where I always say if someone in theory wanted to do contributions for 2025 and 2026,
yes,
they could. So they could do a max, for both years. You do have to do your previous year. So your 2025, you do have to do it before you file your 1040 or your federal tax return. So you have to do that. You can't submit your return, send it in, and then go, oh, I want to do a Roth IRA or pre-tax contribution to my traditional IRA. You need to do it before that or April 15th, which, we have some slackers that are, or extenders. I extend quite often normally because I got business stuff going on. But there are people that, wait until April. They have a simple return, wait until April 14th to submit it. All right, HSA contributions, very, very similar to a pre-tax IRA contribution. And we're still in that great period of time. If you're in an HSA eligible health insurance plan, you still can backfill or do a contribution for 2025. And really this is a vehicle I think is becoming more popular. You do have to be in a high deductible HSA eligible.
I was going to say, will you go into that, what it is and who's eligible?
So not everyone can do an HSA, right? You have to have a health insurance plan that is considered high deductible HSA eligible. So depending on whether you have group insurance or individual, you'd have to find that. Most people know if they're in a high deductible HSA plan because if you're selecting that, it's advantageous to do the HSA. If you're in that plan and you're not doing the HSA, it doesn't really make a lot of sense. Yeah. So, but it's really a triple tax-free bucket if used correctly. So you get a tax deduction going in, it grows tax-free, so similar to your Roth IRA. Mm-hmm. And then if you use it to pay for qualified medical expenses, all that growth or whatever using comes out tax-free. You don't have to claim it.
I definitely think if this is available to you, it's something you should definitely look into because of that. Also, double check your 1099 incomes. And this is very interesting. A lot of I feel like we're in the generation of side hustles and marketing online and influencers. So if you had a side income, Venmo, consulting, marketplaces, make sure everything matches because the IRS is reporting it much tighter now.
Yeah, I know the Venmo transactions, right? There's been a lot of chatter around that. I don't know whatever the final ruling was on that, but I know at one point it was like everything above $600 was going to be reported. Yep. So,
but it's interesting though, because so many people just Venmo back and forth.
Or they pay rent or do things like that where it's like, so it's...
I do love the people who usually use Venmo and they're like, hey, you got cash instead.
I do.
Yes, I do.
I do. This is one thing that I think people should be aware of and conscious of moving forward. Because I think as we're in this world of AI and computers and recognizing everything, and I think that as that advances, not that I want to say of like people are skirting the IRS tax code, but I think it's going to get much more challenging if you're not, doing things by the book or reporting all your income correctly or on that point. I do think it's going to be more and more difficult, and the red flags are going to come up much easier.
Because their technology is going to allow it.
It's automated, right? Yep. There's going to be an AI chatbot or something that's scrubbing, that no human has to work on, and it triggers a red flag, right? I think that's going to get more and more difficult for people that are maybe skirting the boundaries on their tax return.
I would agree, and I will say this just as a sidebar. Integrity, I get it. Everyone wants to find loopholes in the tax system. Yep. We have conversations with people like, how can I...
Everyone always wants to, like, how do I pay less taxes?
Or how do I hide it? Or how do I, how does the government not take it? Just doing it right will take out so much stress of your life, if that makes sense.
Never worth it.
Yeah, it's never worth it. Integrity is everything. And if you have a solid plan and have a solid team of financial advisors, CPA, you will feel much better just doing it the right way. So,
and there is always a difference between the, being illegal or it's like, hey, let's take advantage of what's available, right? And planning, because we
still want you to take advantage.
A lot of things that people do not, take full advantage of, or things they don't know about because they're not working with someone, whether it's our team or a CPA team or whatever.
They're having their neighbor do their taxes.
Yes. So there are plenty of things available to you as long as you're, educating yourself without breaking any rules.
I do want to add this too. If you end up owing, do not panic, but also do not ignore it. I feel like I hear this a lot from people at this time of the year, like, oh, I wasn't planning on owing. I didn't switch, I didn't withhold my taxes correctly. This is the perfect time to sit down and make adjustments now. Like, adjust your withholdings, set up a payment plan if needed, but we need to fix the problem of what made you owe versus ignore it and hope next year works out better for you.
The goal on your withholding is to break even.
Yes,
right?
Thank you.
So you shouldn't pay in anything. In theory, right? If you did it perfect and you knew exactly what you're going to make the year, but there's so many variables of, like, you could have got a bonus, you could have got a raise, you sold a property that you had a gain on, right? There's things that happen throughout the year that you can't always plan on. But if you are, and we're reconciling it now, right? We're at tax return season. So this is where the IRS says, hey, you overpaid $3,000. Here's your $3,000 tax refund. You should be asking, well, why? Like, what do I need to adjust? Is that enough? And maybe it's not enough to adjust that. But if you're getting a $9,000 tax refund, I would
like to challenge our listeners on that too, because if you're getting a big refund, right? And I get it. Some people love that out of sight, out of mind. I won't spend it. But what are you doing when you get that big lump sum? You're probably spending it. You hear people like, oh, I got it.
Or paying off debt because they put more money on a credit card.
But do you want the government to have your money all year, or do you want to have more money throughout the year and make better decisions? Do you want to invest more? Do you want to pay off that debt sooner? Do you want to save it yourself and put it in a high yield saving account? Because basically what you're saying is, hey, hold on to this $9,000 big refund with no interest on it and hold on to it all year and then mail me my money back. So I think some people get excited about a big refund. I just want to reframe that. It's your money.
Yep.
So use it wisely throughout the year if you can. So again, like Cole's saying, try to break even.
And on the other side of that, you don't want to have to pay in a lot either, because there are rules. If there's what's called a safe harbor rule. So if you're not within 10%, so say my total tax liability was $9,000 or let's use $10,000 bucks, and I only paid in through my W-2 job $8,000, right? That's only 80%. There's a 90% threshold that you have to withhold. Otherwise, you have to do quarterly filings the next year.
Yep.
So basically what that means is you pay your normal withholding that you do to your paycheck, but then you have to submit a quarterly payment to the IRS. And even if you're like, oh, I just had a unique thing that's called the 90% safe harbor rule, where you need to do that. And sometimes this happens for people when they're in a pre-retirement year.
Yes.
And you don't want to do it. And then you're like, well, my income's, I'm not going to have to pay that money in, but it didn't matter because I made that mistake because it's a 1 year, it's the next year. You're penalized. Now you'll get it all back in the return, but say it's significant and all of a sudden you got to pay a bunch in and you're like, well,
no one wants that.
That's
Nobody wants that.
So monitor where you're at, knowing that you're staying within that threshold, especially if you're a higher W-2 earner.
And if you've been listening to me and Cole for a while, we want you to be advocates. We're trying to empower you to have control of your situation. No one can fix these or be in charge of these situations but you and your team that you surround yourself with. So a lot has changed, Cole J. So I'm going to let you nerd out for a little bit because this is definitely up your alley. So the SALT cap.
Yeah. So this is probably, I think, one of the bigger changes from 2024 to 2025 and 2026 now. But so in 2024, the SALT taxes, so state and local income tax.
I was going to say,
that's what that stands for. So that's, your property taxes, say for state of Iowa, if we play income tax, there's technically some local taxes if there's other, depending on the municipality and things that you might pay. But that used to be, that deduction was $10,000. So the max, if you paid, $15,000, say you're in Des Moines and you got $20,000 in property taxes, you could deduct up to $10,000 of that. Now that number for 2025, and we're seeing this impact, is $40,000.
Quite the jump.
Yeah, so it's 4 times the amount, and quite significant, I think, for especially if you're in a high property tax, town, or you own a, or you're a high income,
significant property tax.
Yep, and that's a big thing because 10,000 versus 40, obviously you can get much more to fill that bucket up, but you're getting a lot closer to that decision of whether you're going to itemize or take a standard deduction. And this is where we're going to probably see, I was trying to look up the math, but it wasn't
as significant. More people were going to take the itemized.
Yeah. Moving forward, I thought more people, because pre 2016, which was the tax, like the Jobs Act, the most previous tax bill before the one big beautiful bill passed, like half the people switched from itemizing in the U.S. or something like that. It was like ungodly, where everyone was taking the standard deduction because it went up so much. And that's where we're kind of in that pendulum where it's flipping back a little bit, not as much as what I would think based on the math that's out there. But you're going to see a lot more people take, I think, with especially high income tax states. So it's going to be more like your Californias, your New Yorks. Probably locally, we won't see it as much, but still, I think it's more relevant for people in Des Moines that are paying, on the outskirts that are paying, we all know people that have, $15,000, $20,000, property tax bills, and then you're paying $10,000, $15,000 state tax. It's right there. You're above that standard deduction, which is $31,500. So, and I'm going to go in that a little bit deeper on when we go to Cole's Corner. Yeah. So I won't go too far into that.
It is a temporary expansion though.
Yeah. It expires in 2028. Yep. So everything's always, that's one thing with the tax code. It's always
it's always ever changing. It goes back.
It's like always flipping in our brain. And I'm like, well, okay, so this is technically sunset, and then they'll probably renew it in 2028 or take some of the things out. Cause the other things that are in there
in that year, we'll let you know.
Right. These are the hot topic buttons, the no tax on tips.
Yep.
The senior deduction. So if you're above 65, you get an extra $6,000 on top of it.
Hey, you're old. We're going to give you a little more.
Yeah, we were talking about this, and Peter said, hey, Social Security kind of sucks, but here's an extra $6,000 deduction for you.
On your income.
And then what's no tax on overtime?
Yeah.
Right?
Yep.
So those are all, and I think the tax on tips and overtime is $25,000. So you can...
It's a deduction.
If you're an overtime person, I think your adjusted gross income has to be under $300,000. So maybe, I don't know your guys' situation, if Luke has overtime, are going to get to take advantage of that or not. But
bless Luke's soul. Another shout out. He used to do a lot more overtime, but now he's dad mode all the time. So he had a little bit
equalization.
Yeah. We're an equal home house. Psych, I'm way ahead on this. Okay. Another change, always to be aware. Contribution limits have increased. So again, this is the time of year. If you were maxing out last year, these are the new amounts. Go ahead, Cole, that you can contribute this year into your taxable.
Yeah, so I'll do 2025, 2026. So 2025 for 401k, you're just normal under age 50. 23,500 for 2025. 2026 is 24,500. So if you're a person that's saying, hey, I have 26 pay periods, I want to max out my 401k, I need to make sure and make that adjustment for that extra 1,000. The catch-up contribution, so this is for anyone above age 50 for 2025 was 7,500. 2026 it's 8,000. And then the super catch up, this is new. Yeah, between 60 and 63, you get your 23,500 plus 11,250. Or 24,500, 11,250 for.
They're saying, hey, you really are about to retire. You need to buckle some down.
You know what's weird?
I don't know what's
weird about that? If you're 65 and still working,
you can't.
You got to do the regular catch up. It goes back. It's just for 60 to 63. I don't understand.
Why isn't it just 60 plus? Like 50 plus, 60 plus.
I thought it was odd too. I was like, that's interesting that they did, because I assumed that's how it worked. And I went through, I'm like, oh no, that's not how it works. So.
And this is why I do love working, like when people work with advisors, because in the beginning of the year, I reached out to everyone who's already maxing out accounts, IRAs, 401k. I'm like, hey, here's the new amounts. We need to make these adjustments now. And a lot of them are like, yes, please. Because, it's a small increase.
So we have a lot of systematic people, right? Where they're doing a Roth contribution on a monthly basis and it's 12 payments a year.
And it's just, this is the muscle. Like they already have the muscle of investing. Like they just have that built in. It's already automatic. So making that small little change to get to the next max to them is just so normal. So this is why I love talking about this in the beginning of the year. I know it's already end of February. It's crazy, but these are the habits we want you to have, because in the beginning of the year, if you're going through this January, February, your future self's going to thank you so much for maxing these accounts out. So IRA limits, go ahead, Cole.
Yep. So, not as big a changes here, just up $500 on each. So below age 50 for 2025, you're at 7,000. So we're at that stage right now. If you're looking for last year to put in your Roth IRA, it's $7,000. 2026 or $1,000 extra if you're above age 50. Peter, you're getting close to that, aren't you? No. In 2026, it's up $500 on each, so it's $7,500.
I do like it. It's an even little.
They always screw you up though, because we know we do it based on 12. We have a lot of people that max on a 12-month cycle.
Yes.
So you kind of know the math. And like, okay, and then it changes or it gets to a funky number every so often. So like
last year, but hey, it's always good when they increase it. It's an opportunity, so just make sure you're taking advantage of it.
I know we rattled off a lot of numbers there, and I can go into the weeds for days on that stuff, but we'll make sure and link the updated contribution limits for 2025 and 2026 in the show notes.
And I want to add this: if you are not maxing out, don't get discouraged either. I do not compare it like, oh, I can't even get close. That's okay. We're just wherever you're at, you need to be aware of it.
That's a good point, because we always use the example. We always have the people that are like, okay, they're doing the max. Here's how I think it should be done. But we have so many more people that are doing a couple $1,000 a year, because that's what they can afford.
$50 a month.
But what matters is they're consistently saving. Yes. So they're trying to progress to that max amount, but they can't get there yet. So it's not like everyone's got to start at that point. So we always kind of make that assumption.
Same with the tax deduction stuff. Your taxes don't have to look like theirs. So we're just focusing on everyone. There's something here for everyone. Just want to put that out there.
This podcast is produced by Spin Market and Digital. Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market. Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarketwith2ks.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarketwith2ks.com. That's digitalagent@spinmarketwith2ks.com or 515-302-8026. Or visit our website at www.spinmarketwith2ks.com.
We're back. Cole's Corner, where I let him nerd out. Go ahead, Cole.
All right. We're going to, instead of me just rattling a bunch of numbers, we're just going to go. I think this is a common, maybe confusing terminology we're talking about taxes here. So a tax deduction versus a tax credit.
Oh, this is good.
Yeah. So I'm just going to break down the difference. I'll give a little example. So a tax deduction, what it does, it reduces your taxable income. So let's use a $100,000 example. I earn $100,000. I get a $10,000 deduction. I'm now taxed on $90,000. So if you're in the 24% tax bracket, so take that deduction, that $10,000 deduction times 24%, you save $2,400 in tax savings, right? So that's in theory a deduction. So you could use that deduction, could be
college savings.
Yeah, it could be 401k, whatever it might be, whatever you're thinking about in there, your salt deduction on there, right? So that's how that works. But a tax credit really reduces your overall tax bill dollar for dollar. So let's use an example of, hey, I owed $8,000 in taxes, but I qualified for a tax credit, say a child tax credit of $2,000. You now owe $6,000. So it's dollar for dollar off your tax bill. So tax credits, that's why people have probably heard, like in the insurance world or business world, people will sell tax credits because they're dollar for dollar. It's very, very powerful in the tax code. So that's a simple way to remember it. Deduction lowers your income. Credits lower your actual tax bill.
Is that it for it? I love that.
That's it.
And then I'm going to ask you this, Cole. So when people talk to you, because I think this is important too, like when I'm helping people budget, we're budgeting off your net income, but saving, are you saving off your gross income or your taxable income? And I always say gross income because that's what you're actually making, right? That's what we're actually planning for. And just a little caveat for your little Cole's Corner.
And it's most people are saving through their 401k,
yes,
right? Which that percentage, and most people do it on a percentage basis, is based off their gross income.
Yep. But I do have that. People ask me that. Well, can I just save off what I'm netting? I'm like, no, what you're actually making. So if they're doing IRAs. All right. Appreciate that. All right. So now we're going to go into tax strategies by age. Now, to be in your early 20s and 30s, we're not there anymore, Cole.
Hey, I'm still in my early. I consider I'm 34. That's early.
35 is not early.
Am I 35?
You will be.
No, I'm 34. I was like, oh God, you made me question how old I was.
Cole always acts like he's so much younger. 3 years. Woo!
In our industry, though, we are considered super young in our industry.
People do look at me and they're like, she's young. Yeah. And I'm like, trust me, I'm not as...
It's because everyone's 70 in our industry. So,
we're with it. We got the energy. You want us. No, okay. So if you're under 35, I guess, Cool J, you're still there. But also, no, you're probably not here either. You're probably in one of the lower tax brackets you'll be in. Like I'm thinking of myself in my 20s. You know what I mean?
Yeah, especially in your 20s.
Yes.
For sure. When you're just getting out of college in your entry level job.
Yeah.
You know, and you don't have kids and maybe a spouse and other things you're just paying.
You're living. You got a dog.
Those are the times you need. Yeah, you got a dog, which is expensive, I'm sure. Yes. So.
But you don't avoid paying tax 25. This is where you're locking in your low tax rate, and you know what I'm going to say. Roth.
Everyone at this stage in life, you should definitely be putting as much Roth money as possible as you can. When you don't have the other liabilities and other things that are maybe dragging on your savings, get as much as you can. One is hey, you're paying the tax now. Yeah, paying the tax now, grows tax free. But two, it's think of the time, right? The younger you are, the more time that you have in that Roth. That's the most powerful piece of that is the longer it has to grow, the more advantageous it's going to be for you.
And I say this a lot, we manage 401ks and we have a lot of 20-year-olds who have like left a job and they have one and they're always like, what should I do with what's rolled into an IRA? And I'm like, I get so excited for a 20-year-old doing money in a Roth IRA. It's like as exciting as retirement. I'm like, God, they're going to be so well off if they keep doing this.
Well, you just look at, you go and do a retirement calculator. Say you're 22 and you're like, oh, if I put $7,000 this year and I never do anything again and I retire at 65, look what that money, you just put it in the S&P 500. Mm-hmm. Look what that grows to. And you're like, it'll shock a lot of people. And then you think, well, what if I do that for 10 years? Yeah. My first, up until I'm 30.
Where was your money going in 20s?
When I was 22.
I'm just kidding.
Ooh.
I think about that though. If I would have been
not into a Roth IRA.
Yeah, I literally think about that. I'm like, dang, missed opportunity. But
that was probably still I didn't really have super nice vehicles, but probably still like the vehicle age of where I was like.
Oh, see, that was never appealing to me.
It's a boy thing. I think a lot of boys like their pickups and. Just in rural Iowa, it's like it's a stupid thing now.
Put it in a Roth IRA, you young 20-year-old boys. Okay, I said boys because that's what they are. Just kidding. All right, Savers Credit.
Yeah, so this is often overlooked, but this is definitely when you're in your lower income years, right? I think the threshold's like if you're married filing jointly, like your
$80,500.
Is that what it is? Yep. I knew it was low, so you have to. So husband, wife making below $80,500 and you're contributing to a 401k or retirement account, you can actually get a tax credit.
Yep.
I believe up to $2,000 if it's joint, $1,000 if you're single, filing single. Which again, that tax credit super powerful, right?
Yes.
That's $1,000 off your total tax bill or $2,000.
The government is literally rewarding you for saving money at a young age,
and this is
interesting.
You do have to. There's an extra form you do have to fill out. So if you're I think most CPAs, or if you do TurboTax or any of that stuff, it'll automatically prompt you to do this based on your income and stuff. But again, make sure if you're someone in that, what'd you say it was $80,000?
Yep, $8,500, single range, $40,000.
Yep. If you're in that range and you're saving in a 401k or a pre-tax IRA, you should take advantage of that.
I do think this is a good time when you're younger too, is to build the three buckets we always talk about: tax deferred, tax free, taxable. Like, right, we're very pro Roth. I get that, but we're also, if you can at a younger age, because actually statistically these young kids are making a lot more money than their income's up.
And that would be an example of this would be, so let's talk through all three buckets. So a tax deferred, let's say let's use the tax-free, tax-deferred. Let's say in my Roth IRA, I'm doing 5% Roth. My employer's doing a 4% pre-tax max.
Yep.
Knocked out both buckets right there, right? And then you're like, well, I've got an extra $5,000 a year. I don't want to go in my 401k, but I want it in a, maybe for a future down payment on a house, or I might want it for retirement account, but I don't know.
A new truck.
I'm going to start that. I'm going to start that non-qualified account, and then you're building that, and you're technically building all three buckets.
And I think about that if you start that in your 20s and 30s, what that looks like.
Yep.
You know what I mean? 20, 30 years down the road. So
we talk about this next one a lot.
Lifestyle creep.
Yeah, avoid the lifestyle creep.
It's so tough. Like, I think this is probably the hardest thing for anyone. No matter what, I think people forget this. No matter what income, if you're low, high, whatever, lifestyle creep is real for everyone, because we live in a world where everyone's life is available to everyone, and everyone thinks, well, they got it better. Look at you just don't know what's happening.
I also think some of it's the accessibility of everything, of how easy
Apple Pay
stuff. Yeah, I mean, Apple Pay is dangerous.
Yes.
Like how quick I can order clothes or something. I don't even have to put anything in anymore. I just double click the button, it sees my face, and it's in my house in 2 days.
Every raise in your 20, 30s should trigger two things before lifestyle creep. Increase your contributions.
Yep.
And review your withholdings, because let's say you start making more and you don't review withholding, you're not holding enough, and then you're spending that money throughout the year. It's just, if you're in your 35s and...
Unfortunately, the thought process a lot of times with a raise, or say someone gets a bonus, is like, what can I buy?
Yes.
Right? It should be the other way around. So, okay, I think this is, I'm stereotyping here a little bit, or,
generalizing.
Yeah, generalizing is most people will go, okay, I got a $10,000 bonus, unexpected. I want to buy this, and this versus, and then I'll save a little bit more secondary versus it should be the other way around. Like, hey, great, I can put an extra 5,000 in my account, and then I've got 5,000 that
I always say this, you'll enjoy what you're, if you have not listened to our episode with Eddie Thompson, best go back, listen to that. Me and my husband are going through his process right now. And he's like, everything you buy tangibly, depreciate, it's not worth anything. Like, he was just talking about the value of saving and the freedom it's given him, the options it's given him, versus like, you go buy a car, you go buy a new fridge or whatever. And I appreciate Cole Jaskey for this, because there is a balance, right?
Yeah.
We do want you to, we're not saying never enjoy life. We're just saying avoid the creep where it's like building and all of a sudden you have all this debt, or you can't maintain what you've been living like. So I don't know. A balance, right? Like,
it's
we
tough.
want you to pay yourself first. Pay yourself first.
Everyone goes through. I truly believe that there's it's just different levels to everyone's situation.
I do think in your, Cole's I do think mid-30s, and when you start to kind of make a little more, maybe you've paid some debt down.
Your
maybe
emotional intelligence is a little higher.
Yeah, you're starting. Your frontal lobe's fully developed.
Or you're thinking about other things, right? Yeah. It's not like when you're when you're a stage where you first have kids, right? Your priorities shift a little bit from having no kids, and then your kids are then your kids get older and get in travel sports, and then you're even more broke, and then
we're just saying, be aware, right? Yeah. Be aware, and I always tell people, accept your reality. Don't worry about other people's realities. So
we got to get Eddie back on, by the way.
Yeah, we do. Yeah. Okay, 30s and 40s. I guess this is me, Peter, because I'm 37 this year in October. No shout out.
Peter's in there too.
So yeah, that's true. This is, I think, a build one that people increasing the 401k by 1% annually. To me, it's interesting how many people won't set that up automatically. I'm always like, do you want to set that up? And there's a very, and this is just my personal experience. I'm not generalizing, but a lot of people just are like, oh, when I get there. I'm like, it's 1%, and it makes such a big difference. Why do you think that is?
It is an odd, we do have that a lot, and most people don't, because they've
just been saving 5% their whole life.
And what we're talking about is most 401k plans now have the ability to set up an auto increase. So you go in, sign for your 401k today. Mm-hmm. It'll say, oh, what deferral you want to do? You're like you want to do 5%. And then it'll ask the next question a lot. I'm like, do you want to set up an auto increase? We can do a 1% or 2% on, February 23rd of every year.
Because statistically, you'll get a raise.
Yes. And that's where...
Maybe not.
Most people don't do it.
And it's such a little amount. Like, I don't think people understand the math. Like, oh, if I contribute 5% versus 6%. You know what I mean? I think they think this is going to change their life drastically.
And I would say, I don't know. I'd like to know what the stats are on people that get raises, you know, on businesses that have a 401k with a match. They're probably in a business where they're getting some type of merit raise or something ongoing. And that's really what we want. We want to see you pay yourself in proportion to your raise, right?
And I'm going to tie this in because inflation's real.
Yep.
The world feels more expensive, I think, to everyone. Lifestyle creep, right? So again, everyone's like, well, I can't afford to do 1 more % because the world's so expensive. That again, are you saving first? Are you paying yourself first? And like, these are the tax advantage accounts you need to take advantage now in your 30s and 40s, because you don't want to be 55 and 60 and be like, I wish I would have done this. You know what I mean? It's kind of that. It's always kind of a hard come to reality when someone they go through maybe 3, 4, 5 years of planning with you and they're kind of saving the same dollar amount, but you look at their income and you're like, I'm like, well, you didn't save any more. You know, you just absorbed it somewhere. You know, I mean, more money in the bank. You maybe bought a nicer car or bought better clothes, whatever it might be. And we're just trying to, again, that balance of like, hey, it should be, if your income is going up, hopefully your savings looks like it's on the same, if it's on a bar chart or a line graph. Let's go back to middle school, line graphs. I will die on this hill, I think, as long as I'm a financial advisor, is you will enjoy the vacation more. You will enjoy the truck more, the clothes, your kids travel, whatever, if you know you're saving too. Yep. I think it's the people that are trying to do these things and live for now, but they know they're feeling super behind in the future, because everyone wants to retire or have that freedom of retiring. You have to have a give and take, right? You can't really enjoy these things if you're feeling the stress and pressure of not saving over here. So if you're saving, when you do those things, you enjoy it a little more. So look at that rant we went on over that. 1% increase. All right. Dependent care, flex spend or savings accounts, and child care credit. So if your employer offers these flex spending accounts, it's pre-tax dollars, meaning let's say it's up to $5,000. Yep. $5,000 that allows you to pay for child care, dependent care, and it comes off your income. Take advantage of it.
I mean, it's not every business offer, or it has to be offered through your employer. Yeah, through your employer. It's becoming more popular though. Definitely is. But and it's one thing about this is a use it or lose it type thing. So you have to use it for that year.
If you select, I want the max, and you don't end up using it.
Versus an HSA, right? These are, you
got to know your situation.
On paper, they look very similar, but HSA has a lot more flexibility and can be carried with you. You leave the employer, you go somewhere, you have the money in the HSA, you still can use it down the road. You maybe can't contribute if you change your plan or something, but that money versus the flexible spending account, you do have to use that year.
And then the child care credit. I feel like most people know about this if they have children, but maybe not.
Yeah. So again, it's a credit back. So just a percentage back, but nothing too crazy. They kind of mold together.
Anyone doing your taxes.
Yeah. I would hope if you're using any type of software, right? If you're filling out the 1040 manually, you could still make some of these mistakes, but I don't know if there's any CPA or
everyone knows about their child tax credit. Like, I paid for these children all year. Give me my credit.
Actually, let us know. Send us an email or text or something. If you know of someone that's still doing a handwritten tax return.
Oh my gosh.
I want to know if they're still out there. Maybe there still is.
Do you die when someone's balancing their checkbook in line?
I did a paper tax return 7 years ago just to see if I could do it. But I went to accounting school, so I was like, I'll just want to try.
Yeah, different.
Yeah. My taxes were also different then than they are now.
Yeah.
That's it. I'm sure there's still plenty of people that are doing it. It just seems, people. But what were you saying about balancing a checkbook?
When an old lady's at Hy-Vee and she's like, "Hold on, I got to balance my checkbook after she," I'm like, log into your bank account.
I do find there's something about that old fashioned of balancing the checkbook when someone writes us a check in the office, and then they go and they got their ledger. I'm like,
Gen Z doesn't even own checkbooks. Like the amount of people that don't own checkbooks.
I'm like, hey, can I get a voided check? And they're like, I've never written a check.
Just need that account number. Okay, another deduction, college savings, $529. I want to say this. I don't forget. Like, we're in the state of Iowa, but we service all
very
over the
state specific,
right? But you still want to take advantage of those. They're evolving, right? So yes, like I'm saving for my kids' college. That's the purpose of this vehicle. I get a deduction, so I want to take advantage of that. But also know they can use it for other things if they don't end up going to college. But it's a great tool for people who need a little deduction and you want to put some money away for the kids.
This is one a lot of people do miss in Iowa. They do the contributions, but they forget to report it.
Yes.
Yeah, because a lot of times for contribution amounts, there's no direct tax form that gets sent to you that says, hey, you put $3,000 in this 520, you need to report it to your CPA, or if you do your tax return, you need to put it on, hey, I did a contribution to a state sponsored 529. That is very state specific. Each state has their own rules. We're obviously using Iowa as the most common example for us, but each state, again, depending where you're located, just find your state sponsored 529.
Definitely something you want to review if you haven't submitted your taxes, or keep aware next year. So another thing, audit your W-4. Cole J.
Yeah, so this
is your world, I feel
this is definitely if you have a big discrepancy in your, return, right? And by discrepancy, I mean, hey, you got a big refund or you had to pay a big chunk in, right? Your W-4s where you're withholding what you're telling your employer to withhold. So this is a big piece. You need to go through this, especially if you got a raise, right? If you know you got a big raise or position, maybe your title changed, something in there. And because most employers are just going to default to your original withholding.
I do hear that a lot. Even, my husband started making more and we didn't think about it and we didn't change our W-4. I do love Luke's union. Every time they all work overtime, they'll go in and adjust their W-4 and adjust it back. I'm like, you guys.
Other thing would be, say your spouse, right? Your spouse maybe made significantly more, something that kind of impacts, but it's like, well, maybe one, it's lopsided, but one made more. You might need to adjust or counterbalance just based on the two.
Yep. If you're married, finally, jointly work as a team in this aspect.
Bonuses are another thing that everyone, gets all up in arms about a bonus, or they get something and like, I got, that's just take that into account. If you're in a business or you work for a company that does, discretionary bonuses or larger bonuses at times, just make sure you're aware of that and maybe plan a little bit ahead of time.
And last thing, in your 30 to 40s, my generation of people, not Cole Jaski's. Just kidding. Again, if you get a big refund, I know we already said this, but you overpaid. I just want to stress this. Like, you don't need to overpay the government. Like, I don't think anyone in the world would say, oh, I would love to give the government more money.
Well, you look at the last, let's think of this concept, right? If someone's like, well, obviously, if you're disciplined, really disciplined, and you do a good job of saving, you got a cushion, you can afford to write a check in, you definitely want to even under withhold a little bit, right? Now, if you're one, it's like, man, I don't know if I could pay the tax bill if it came, so I need to over withhold and get your refund.
And get a little,
But here's the opportunity cost that you're missing, right? Is think of the last 3 years, the equity market, the S&P 500, almost 20% for the last 3 years, 20%. So if you're like, hey, I overpaid $5,000 the last 3 years, 15,000, but I could have had that money invested, or put in the market. And I'm not saying you're going to just invest the extra, but you put that in theory of like what that 15,000 costs you not being able to invest, or you having control versus, you're not getting a very good return with the IRS at this point.
Even if you didn't want to put it in the market, a high yield savings account and money markets are paying 4%. You know what I mean? Like, so 4% on that versus
what you're missing out. What you're missing out, and then every dollar matters. And it's like, well, if I can earn money on my money, that's the goal.
And we talk about this with people too. We were talking about this off air, and we're going on another tangent, but you got to take some risks to make, you need your money to work for you. And that's what we want. What we're trying to do in this episode is set you up for a successful tax season so your money can work for you all throughout the year. So, all right, 50s. I love 50-year-olds. They're just like, they're ready. They're just in their leverage decade. You know what I mean? They're like, they see retirement. They see it. They got like, I
wonder what that's like, right? When you're like 58,
you're so far away.
You're 58 and you're like, I'm getting close. I'm maybe going to pull the trigger at 60. Like, that's got to be such a weird feeling, but also like we talk about it so much. It's so like not real to us, but I'm like, that's all we do.
I had a client the other day. He said he's in his 80s now, 70. He sold a business anyways. He's like, my 50s were the best. We had money, but the kids were gone, but we could like travel. And I was like, okay.
It is. You do see a lot of that once the
it's
kids
like a
are
new
kind
chapter.
of all, and some people it's really sad point, but they do start to like explore. Explore, right? But this is, you start to open up access to different things. And once you're at 50, and we talked a lot about those catch-up contributions, that's really the main, I would say the thing that covers a lot of people or the masses is, hey, now you can go from that, 30 or 20, was it 23.5 or 24.5 for this year? Yep. You get that extra $7,000-$8,000 of
it makes a difference, though.
Of course, especially if you're in if you're in a higher income tax, say you're paying 24%, income tax bracket, and you save another, $5,000-$8,000. That's significant, retirement savings plus tax savings.
Yeah. Another thing, not for everyone, you have to be able to pay the tax bill. It has to be situational, but this is a good time. Roth conversions. I feel like this is becoming a very hot topic around this age to people who have no Roth money or wish they would have had some Roth money.
Definitely having more conversations around this. People are becoming more aware.
Absolutely.
And I think one of the things that people, if you're in this age, so if you're in this 50 to 60, age range, and you're considering you're closer to retirement than you're not, is what happened. And if you have most of your money's all in pre-tax, right? And those are the people that we're talking about this are like, hey, I have a 401k, I've been contributing 30 years, I have $1 million.
$1
million all pre-tax. You're like, I'd like to have some Roth money because it's tax free. We
want probably my income to be lower in retirement.
And main reason being is I always ask someone, like, well, what if you need hey, we know you're going to need X amount from this pre-tax bucket. You're going to pay this amount of cash. But what if you want to buy a car?
A boat.
You don't want to, boat. And you want to take an extra 50 or 60,000 bucks. That skyrockets your income tax liability by doing that. So if we can absorb, say you're 55, and we can kind of do a 5-year plan of like, well, let's take 25,000 a year.
Yep.
We're going to pay a little more tax as we go, but it's not going to be the same as if we took 125.
Yes.
And we're going to do conversions into that Roth bucket and try to build kind of a bigger nest egg that allows us to, if we have those one-off bigger events, we don't have to just say
your income doesn't have to jack up for one purchase,
and you're biting the bullet on the tax liability for that one purchase.
I love Roth money. I think I get so excited thinking about it. I don't. Okay, we'll go. 50s, 60s, capital gain harvesting. I want you to explain this because I don't think a lot of people understand this. This is
Yeah, this is definitely hard to explain, but it's as you really accumulate, and this is more tied to non-qualified dollars.
Yes, thank you.
In your IRAs and your 401ks, it doesn't matter. You can buy and sell, do whatever you want because the money's only taxed when it comes out, right? In a non-qualified account, and harvesting the gains, what we're talking about here is like, say you've had Apple stock for 20 years, and it's you maybe started with 10,000, now it's worth 100. And you have $90,000 worth of gains. We're talking about, hey, let's start diversifying, maybe trimming some of those gains out there. Now, this is going to be very, very specific to each individual because there's also a benefit to waiting. If your taxable income is going to drop significantly when you retire, you might pay far less capital gains tax. So very situational, but if you're someone that maybe has a pension or you're like, hey, my income is going to be relatively similar in retirement or taxable income, right? We might want to do some of this to free up. Again, we're kind of like resetting. So we have availability to some capital without, again, triggering every time we want a larger purchase or a bigger dollar amount outside the ordinary. There's always a big tax implication, but sometimes we can do a little year-to-year planning, on that, or where we're saying, hey, we're gonna start absorbing kind of this amount of gains
you're
each
planning
year.
the taxing. Yep.
And we space out the tax liability is what we're trying to do.
There's another one. This is very one-off specific, but I think you should just go into a little for a listener who maybe this pertain to, but charitable bunching or donor advised funds that you've been doing.
Yeah. And this is combining multiple years of gifting. So you're someone like, hey, I gift, $15,000, $20,000 a year, maybe to a church, different organizations. You're going to bunch some of those up, and you might do things such as a donor advised fund, or maybe you're just going to give to that organization directly and you're just doing multiple years worth of gifting. You do have to be aware of different, tax implications and how much you can, but this is very specific. I would say if you're someone then the next couple of years, you're considering you're going to have a liquidity event, maybe inheritance or selling a business is the most common one, where you're going to realize some type of income or taxable gain from that business sale or a large sale of real estate, something there's the ability to, if you're already gifting, to kind of pre-gift
you're giving it all
and getting that tax deduction on a year where you're like, maybe your income skyrocketed because of that liquidity event.
Yeah. Just, it's good if you're in that situation.
Be aware of.
Yes. And that could even pertain to 60 plus, which we're going into the retiree 60 plus, what to do in tax season. Can you imagine? I just seems so far away, yet so close, 60 plus.
It does seem a long ways away.
Yeah. This is a stage now about really saving taxes. It's about controlling them. This is your goal in your 60s. Obviously, you're hopefully in retirement, near retirement, Social Security taxation, other incomes, how they affect your Social Security. We don't want you turning on Social Security if you're going to make over the limit. You got to know your incomes.
This is, I would say, kind of like a gripe. A lot of people just automatically associate, I'm retiring from my normal W-2 job, I have to kick on Social Security right away, right? And everyone always thinks that's just like the process. It's not always the case, because you do want to go through. You're like, well, I'm going to work part-time, but I'm going to work like 25 hours. I'm going to make 45 grand.
Yes.
And all of a sudden I'm like, well, why? And they're like, we're just kicking on Social Security because we want to start seeing it. Yeah, we want to start seeing it come. And then you're like, well, now you're paying more in your pre-full retirement, and you're just paying more taxation on that Social Security. So I challenge people, go through an assessment, with whether it's a financial professional like us or your CPA or whatever it is, and make sure that you're not, causing extra taxation when it's not needed, and a reduced lifetime benefit, right? Because once you start your Social Security benefit, you're really locked in for your lifetime.
Crazy. Just turn it on and go, no thought. We want you to think deeply about this strategically. We want you to talk to someone about this part. So Medicare IRMA thresholds.
Yeah, this is specific, I would say, to people, one, that you're got to be on Medicare or getting to, you're transitioning or getting close. So what IRMA is income related monthly adjustment amount. So take that for what it's worth. But really what this is if you make above certain limits and you're on Medicare, you're going to pay a higher Part B or Part A and Part B dollar amount that you're going to pay.
So remember, when you take that big pre-tax distribution up, it jacks up your income.
There's a two-year look back too. So if you're getting on Medicare in 2026, what happened in 2024 is how those premiums are going to be based on. Yeah. So if Bailey made a great example in 2024, you're like, I took $80,000 out of my IRA because of whatever situation, you didn't save raw, and it moved your income up and it pushed you above those IRMA limits or the IRMA thresholds. Now all of a sudden you're paying more for your Part A and Part B premiums for the next year.
Yeah. It's also good to be aware if you're making less, and maybe you were a high income earner and you worked later into your life and now you're making less, you maybe need to go adjust it. So something to just be aware of and strategically plan for. All right, RMDs, man, we're getting up in the age. We're past 70.
Yeah, QCDs, RMDs. Yep. So they qualified, you'll hear the acronym QCDs. So that's Qualified Charitable Distributions. These are relatable to people that are at required minimum distribution age. So you have to be there to be able to do this. But basically this is a direct gifting out of your IRA. Yep. So you're writing a check, or
the government's making you take this money out at this point.
And this would be example, say I'm 75.
Golfing in Arizona.
Golfing in Arizona, a little tanner than I am now. And the IRS says, hey, my required minimum distribution is $10,000 for this year. And what I'm going to do with that, and I have a good advisor who's helping me plan. He says, hey, Cole, you always gift $10,000 to your church anyways. Why don't you just write that check out of your IRA account?
Yes.
I write the check out of IRA. That satisfies the distribution that the IRS says I have to take. I no longer have to claim it. And the church gets that $10,000 and they don't have to do anything with it other than whatever they want to spend it on.
And you were already giving it anyways. Like a lot of people, it's the old throw the cash in the little container. That we want you to strategically know about these things. And if you have a good team, CPA, financial advisor, they're already walking through this with you.
If you are a person that does like to give, we have a lot of people that want to give on a month or on a weekly basis. They like to put it in their, write the check or give cash. We do have most firms, custodian firms have the ability to have a checkbook tied to your IRA. So you can write a check every week and then it's tracked. We can
even set it automatically where you don't even have to write it. It literally just goes out.
But some people are old school and they like that. They want to physically give something.
Especially with giving. I want to add this at the very end of this. I know who knew we could talk about taxes this long? I know it's tough, but something about no matter what age you are, same muscle as investing. The sooner you do it, the sooner it just becomes you. Same with charitable giving. You don't have to be 50, 60, 70 to give. Something about even our age, Cole's, thinks he's so much younger. It's something about giving already. You know what I mean? It really impacts your financial plan throughout your whole situation. So I just want to add that. This isn't just for people who are older and retired. Charitable giving can be done at any age. Yep. So again, who thought we could talk about taxes this long? So we want 4 things you to do this year to make, your tax year this year and next year better. No matter what age you are, you can all do these things. And then if you're retired, I understand this might not pertain to you, but increase your retirement contributions by the end of this month, please. If you have not done it and you are able to, if you're like, hey, that's one last time me and my family go out to eat this month because we're just going to contribute even $50 more, please do that. Review your W-4 before summer. Make sure your withholdings are, if you have a raise.
If you're retired, you can, and you're taking distributions out of your retirement account, so you can review your withholdings there as well. Number 3, you can run a tax projection before year quarter 4. Yeah. I mean, these are...
Work with your CPA. Ask him like, hey, I ended up paying in. What do I need to do?
Especially for the variable income earners, people that are maybe, commission-based or things where your years kind of can fluctuate. Make sure you're staying on top of that.
And if you are in a historical low bracket, explore Roth conversions. Honestly, if this is the time we get so many people like 65, like, oh, I wish I would have done some then. I wish I would have looked into this. Today's the day. Just look at it this year. We just want you to be aware of all these strategies. We want you to be aware of this terminology. We do not expect you to retain all this terminology.
I do think number 4 is super valid for people that have maybe a life event where maybe a spouse was off work or someone got laid off and your taxable income went down drastically for 1 year, or you're like, hey, I'm looking 2026 is going to be a lot less than 2025. Mm-hmm. Maybe that's a year where we're like, well, we can absorb, we already paid that higher tax, but we've been used to that.
Yes.
Let's do a Roth conversion because our taxable income is lower than what it has been.
Absolutely. All good stuff today. I will say this to end the episode. Taxes affect everyone. Integrity is everything. Don't avoid them. You don't have to completely understand it. Have a CPA, have a team you trust that can help you through this, an advisor. But we've had a lot of buzz around the podcast lately. So I just want to say shout out. We appreciate it. We've had a lot of people saying they're listening, learning, and this is what these type of episodes are for, even when it's not fun. I mean, me and Cole J probably think it's fun, but it's not fun to you. It's educational. It's empowering. It's the little things that make a big difference. And please share and like this podcast if you are listening.
We appreciate the feedback and does always kind of gives a little bit of motivation. And we're like, we're recording in a room. You kind of forget like, oh yeah, there are people that
me and Cole could be professional yappers without being.
Of course.
So, all right, here's the quote of the day. You do not rise to the level of your goals. You fall to the level of your systems. James Clear.
You've been listening to How to Money with Cole and Bailey, the podcast of Full Swing Financial Planning. To learn more, visit their website at www.fullswingfinancial.com and follow them on Facebook and LinkedIn. Security and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA, SIPC.